In this video, we're going to go over a finance sales type lease first with the lessee, and then we'll see that the next one gives us the same scenario but with the lessor. So I've mapped it out up here. Again, I'm going to use the financial formulas in Excel. So here it gives us they're making semi-annual lease payments of $562,907 over a 3-year lease term. But again, they're making semi-annual lease payments, so there's 6 then every 6 months. So 2 times 3. The incremental borrowing rate is 5% a year, so we're going to want to divide that by 2 when we put it into our formula. And so the first thing it says is to determine that present value. So again, I'm going to go to formulas, financial, down to present value. And like I said, the rate is going to be 10 divided by 2, so it's going to be 5. And we got to put it in as a decimal. The N is going to be the 6. The payment is the $562,907. No future value. And then the first payment's going to be made on January. So we want to put in a 1. No. A 1. Because again, look down here. If the payment's made at the beginning of the period, make it a 1. So then we hit enter, and then we see it's basically $3 million. So that's what the problem wants us to use, is the $3 million. Now then down here, I'm going to amortize it. So that's our payment. Whoops. Don't want that all to open. What did I just do? Let me undo that. Okay, so that's our payment. It's the same amount for all. I don't think it's 5 times, though, is it? It's 6 times. Okay, then if we go in here, we can amortize it to figure out, well, how much out of that payment goes to principal and how much goes to interest. So again, if we go to our formulas, this time it is the PMT, so that is the principal out of that payment. And then the rate is going to be the same, the 0.05. The payment number is going to be, I'm going to go to this cell and reference, sorry, too few arguments. Let me start it over so we can see it. Okay, so again, the rate, oh wait, I wasn't going to do it that way, go back. Okay, so the rate is the 0.05 for half the year. The payment is going to be that cell. The number is going to be the 6. Yeah. Then the PV is 3 million. And then no future value. And then if we carry that down, it should do it because, oh wait, let me make sure. Darn, okay. No, I want to go, all right, let me go back to this one and then make it. Oh, I see what it's doing. Okay, so it's increasing that 6. That one, but I just wanted to drag it down and not have to do it each time, but maybe I will. Okay, so all I think I need to change though is the, so we want it to be the N11, that part's right. We want it to be 6. Oh, this is the, I see what that is. Yeah, we want that to be O, we want this to be 05. We just didn't want that to drag with each one and make that bigger, but we wanted the ones to drag. Okay, so there we go. Okay, then we'll do the same thing for the interest. So that interest is going to be the IPMT. And our rate is going to be the 0.05. Our number is going to be that cell. Our N is going to be 6. Our present value is going to be that cell, but again, I'm going to make it, I'm going to put my $sign in there so it doesn't change. No future value, and then say OK. And then now we will carry that down. Okay, then the balance is going to be this plus that. And then we want that first one to stay. Well, I guess it doesn't. No, that's the next one. We'll want to do that. Okay, so then we're going to take this minus that, next one, and then then we'll drag that all the way down. Oh, sorry, I need to add. Then we can see we've properly amortized that out. So this one doesn't ask us to go that far, but you may have ones in the homework that do. So I like to do it again, like using Excel, just because it gives you good experience using Excel or using a financial calculator. Okay, so then that was basically one with some additional stuff. So then number 2, what amounts related to the lease would Georgia Atlantic have on its balance sheet? So then they're going to have a right to use asset for the $3 million. We're going to round that, $2,999,972. Okay, and then they're also going to have a lease payable. So then that would be at the beginning. So that's going to be their January 1st entry. Then when they make their December 31st payment, then they're going to, I guess that the January 1st payment would also be the January 1st payment would be made or sorry, it's not it's June 30th, would be made initially, and there would be no interest. So, all right, so we would say that would be a debit to the lease payable for the payment amount, the $562,907, and then they would credit cash. That would all be at June 30th. Then at the December 31st entry, then that is when they're going to have the allocation between the interest and then the cash. And I think if I go back to my, so this is going to be the first payment, but I think because my interest is not quite exactly right, but I think because I made this payment in advance. So this would be more if it was if all the payments were made at the end of the year. So the first payment though is going to be the 441,052.36 coming out of the lease payment, and then the cash is a 562,907, and then the difference is going to be the interest. So see that my numbers are a little bit off, I think, because again, it's assuming the payments are made at the end. I don't think I properly set that. But again, play around with that. In this case, it doesn't really matter because we didn't have to do it. I was just trying to show you how to set up that amortization table. But in this case, the interest expense is going to be that difference. So that's what you need to know for that one. Then the other thing that they do as the lessee is they amortize it. So then they're going to debit amortization expense for the $3 million, and then they're going to divide that by the 6 payments. Okay, yes, I want that to go. So that's going to be $500,000 a year, and then they're going to credit the right of use asset. So those would be their entries. So then if we think about it, what would be on their balance sheet then at the end of the year? They would have the right to use asset. They would start it at the $3 million. Then they would have reduced it by the 500,000. So then 2,500,000 would be the value at the end of the year. And then in expenses on the income statement, they would have the interest expense, and then they'd have the amortization expense. So remember, again, you'll have those two components of expense that will be on the leasee's books, and then they'd have a right to use asset, and then they'd have the offsetting lease liability too. So those would both be the same, the lease liability. Lease liability, let me do it over here. The lease liability would have started at the $3 million, and then we would have reduced it by 562,907, and then we would have reduced it by the 441. So then that would be our balance in that lease liability at the end of the year. Then if we were over on the lessor side, again, it's the same scenario, but then what would they record? So then we don't have to redo those computations because they're the same. So they would have a lease receivable for $3 million. And then they would have they would take the equipment off of their books, because again, it's a sales type lease, for $3 million. And then they would then receive the cash payment. And then they would credit the lease receivable. Then at the year end, then they would do the same entry as the other one. They would receive the cash for the 562,907. They would reduce their lease receivable. by that 441,052. And then the difference would be, interest. Now, in this case, that would be revenue, because again, they're on the other side. So then again, that's a sales type lease with the lessor and the lessee. And then again, I just tried to add to it with that amortization schedule. But because it was a beginning payment and then an ending payment, my amortization schedule didn't quite work out. But I think you'll have one in the homework that will be at the ending that you could do it that way. Okay, then this one we have an operating lease. So we have the company leased high-tech equipment from Courtney Leasing on January 1st. They purchased the equipment from, so Courtney purchased the equipment from Doan Machines at a cost of $250,000, which is its fair value. So then the lease term is 2 years with 8 quarterly payments. The quarterly lease payments are $15,000. And then the economic life of the asset is 5 years and the interest rate is 8%. So let's come over and put those in. So our N is going to be the 8 periods. The 8% quarterly is going to be our interest rate. $15,000 is our payment. No future value. And then we're going to compute the present value. So that, go back to our formulas. Okay, so our present value, again, the rate is the 0.02. The N is 8. The payment is $15,000. No future value. And then our type, again, because it starts with a 1, it starts at January 1st. They make a payment initially. That is going to be our present value. So then that's what they're going to record. So then our journal entry that we would initially do is our right of use asset at the 112,080 if we round it to the nearest dollar. And then we're going to set up the lease payable at that same amount. And then when we make our first payment, we're going, because it's going to be on that same day, we're going to debit the lease payable for the $15,000, and then we're going to credit cash for the $15,000. Okay, then if we amortize it, so let me just try to do one. I'm not going to do the whole table, but so like let's just do the P to figure out what the P payment. So then our rate is the 0.02. We are on the first payment. We have 8 total payments. The present value is be negative, right? Let me just see if that's, yeah, okay. And then say okay. What did I? Oh, I didn't put in the. Zero in there. Is that what I'm missing in that number? Let's just make it the 182,080. That's the amount of the principal. So then that would be in the March 31st payment. So then our payment would be, we would debit the lease payable for the $13,058.42. We would credit the interest, or sorry, we would debit the interest expense. And then we credit cash. Cash if I could type. And then I'm going to take the difference with it. So then that saves me a little bit of time from having to do that interest one. So then that would be the amount of your interest that you would pay on that March 31st. So all of these again would be the January 1st. That'd be the end of your quarter. And then you would have to do your amortization expense though. So I guess we will do that quarterly as well. And let me see here. So it's not like, it's not a straight line on this one though. So the amortization expense, how they have it calculated is that we would take the 15,000, so it's the amount that goes to the lease payable. Sorry about that. So it's the 13,058.42 that then we're charging off to expense, and then we're reducing our rate to use. So then we would again continue to amortize it out over its life. So if we went back to calculate that principal, again, if we made that our payment 2, then that would be the amount that we would use at our next payment. And again, the difference would go to the interest. So you would just go through and do that for every quarter to create what that interest is.